Welcome to the next video in the stock market trading system video series here on YouTube, geared for option traders who are looking to buy single, call, and put options. My name is Eric, and by the end of this video, you're going to learn how to make more money trading less using the simple trick of establishing the current market conditions. This is going to help you decide which direction to trade in, and the results I'm going to show you trading SPY in this manner, you're going to see exactly how you made more money by actually trading less and being out of the market less. And we know when we're out of the market less, we have less risk in the market, and that's part of the game, right? And if you haven't done so already, be sure to subscribe to the channel, click that little bell notification so you don't miss the next video in the series. And I'm also going to put a few things in the description of this video here on YouTube, such as the market timing strategy guide. That's kind of an overview of this series, as well as some Thinkorswim resources. You're going to see us dive into the platform. So if you want the strategy for your Thinkorswim platform, I'm going to put some links in there as well. All right, so let's get started. So before we dive into the charts and stuff, I want to talk a little bit about overtrading. It's kind of a problem, especially if you're new. You feel like there's always something going on in the market, whether it's tweets out of Washington, the Fed, or whatever. There's always movement in the market, and that will always be. And one of the things I want to kind of convey in this video is that you don't have to be in the market all the time to make money. And I'm going to show you later how actually by being out of the market more, you actually made more money. We want to be selective. We want to trade with a scalpel and not a machete. And by over trading, you're going to increase your commissions, which ultimately takes away from your profits. And it's also can wear away at your confidence when have a lot of losing trades. Yeah, you're gonna be in the market for that big winner, but I want you to kind of think about FOMO and think about those trades you've taken in the past. I know I've done it and I still do it. It's hard sometimes, but the fear of missing out is real. And I'm hoping this video is going to show you how to, stay out of the market when you don't need to be and how that can actually improve your results. And you'll see in a minute what I'm talking about. So the way we're going to make more money and trade less is by using multiple time frames. So by using multiple time frames in the way that I'm going to show you in this video, you're only going to be taking trades in the direction of the larger time frame. I didn't invent this. You've heard this before. I'm just here to show you the actual results with the way that I do this. And you're going to see that in a minute. We're going to compare the profit results. We're going to look at trading on a hourly chart where we're taking trades long, short with the hourly chart only. We're going to look at the results, how many trades, and then I'm going to show you the results of trading the hourly chart, but only trading in the direction that the daily chart is telling us to trade in. And I'm going to show you all of that. But the takeaway here is you're going to be taking trades just in the direction of the larger time frame so that you are not in the market all the time. And one thing I want to clarify, I guess, is, I know a lot of people use moving averages. I use them too. And you can look at a daily chart with different moving averages, and some people think that that's multiple time frames. For example, if you use the 50-day moving average and the 20-day, and maybe you're using like an 8 EMA crossover, something like that, you're using a single indicator on different time periods, but you are not using different time frames on the same chart. So I just wanted to kind of mention that nuance. So using different moving averages, it is a form of multiple time frames, but if you're trading above the 200-day moving average, maybe you want to trade more in the long direction. That's some things. But when you're trading short term, especially trading directional options, buying calls and puts, you need something more than that to be consistently profitable. So the method we're going to be doing is instead of using multiple indicators on a single time frame, we're going to be doing one indicator, the MOBO Bands Indicator, and we're going to be using it on 2 time frames. So one indicator, 2 time frames, as opposed to multiple moving averages, which is 3 or 4 indicators on 1 time frame. So that is my I don't say definition, but that's my version that I wanted to clarify with you guys that we're going to be using multiple time frames, meaning 2 different time frames on the chart. And as I mentioned, the example we're going to do is the daily chart and the hourly chart versus just the hourly chart. And we're going to only be using that one indicator with the MOBO bands. So if you haven't watched the MOBO indicator video that's part of this series, be sure to check that out. You can look at the playlist on the channel, and I'll put a link in the description of this video as well. But that's going to give you a little bit more insight to the indicator. We're not going to cover that. We're just going to look at the results and compare those results in this video. So be sure to check that out. All right, so we're going to go ahead and dive into the Thinkorswim platform. Let me bring that up. All right, so we're in the Thinkorswim platform, and I've got 2 charts up there, the exact same chart of SPY. They're both a 1-hour chart going back 360 days. That's about a year and a half. I think it's 18 months or so. And you can see on this side, we have the same thing. I have the same indicator. This is the FW MOBO Basic. FW MOBO Basic, that's just the indicator on the screen. And this is the time frame we're looking at. Now, underneath, I have the floating P&L for the strategy. And this is the difference between the 2 charts. On the right-hand side, this is just taking trades every time you get a close below or above the band. In the short version, I got another video coming that's going to really talk about the entries and exits and how they work and modifications and blah blah blah. But for this video, we want to establish the market conditions so we know which direction to trade in. If you're trading on the right here, you're taking every trade. Back at this level, we closed below the band, which is a shorting opportunity, and it worked out. You can see in both trades it actually worked out. But what the chart on the right did, I want you to just look at the P&L here. The P&L, during this route, had a nice little spike up. But then as the market got choppy, you gave back a lot of the gains because you were going long and then going short, meaning you were in the market with the strategy on the right. You're in the market 100% of the time. You're going long on a close above the upper band, and you're closing your trade and going short on the lower band, on a close below the lower band. And you can see what that did to your profit. You had a profit at some point of $2,900, and over this choppiness, you gave back a lot of your gains, and you only ended up about $1,500 here. So to go from almost 3,000 to about half, your profits got cut in half because you're in the market the whole time, going up, going down, getting chopped around. Doesn't mean you won't get chopped around on the right, but let's just compare the multiple time frames. So in this chart on the left, you're only taking the trades if the larger time frame is bullish or bearish, right? You're taking only taking trades in that direction of that bullish or bearish signal. So I'm going to flip up to the daily chart, and you can see that during this time frame, the daily chart went short. So what that means is we're only going to be taking trades in the direction of the short signal here. So if I go back to the hourly chart, let me zoom back a little bit. So in this case, we're shorting just like we did over here, but instead of going long up here, we're just going to close the trade. Shorting, and the close back above is saying, hey, get out, and then we're waiting for the next short. We shorted, and you can see we lost a little bit of money. It went long. We shorted. We lost a little bit of money again, but shorted and made money. So you can see the difference between the losses here. So here, the gains were, $6,800, and this is trading 100 shares at a time, by the way. And we did get chopped around because that's what the market does, and we gave back some of our gains, but we did not give back half of our gains like we did over here. So over the course of the last 360 days, by only trading in the direction of the larger time frame, which I'm saying that's our stock market conditions. The larger time frame in this combination is the daily chart and the hourly chart. You made, what is that? Three or four times the amount of money. So this is the first part of the video that I talked about, is you made more money by only trading in the direction of the larger time frame, and that larger time frame are the stock market conditions that I was, kind of started off with. When the larger time frame is bearish, you're only going to take those bearish trades and you're going to wait for that to flip. It doesn't mean you're not going to have losers, doesn't mean you're not going to get chopped around a lot, but you can see the losers are a lot smaller and you're not giving back half of your gains in the over the course of a week or two, right? So the other thing I want to kind of show you here is I'm going to on the strategy report, I'm going to right click, I'm going to show the report, and this is going to give you all the trades here. And in the description of the video, I'm going to put a link to an article over on my Patreon website, totally free. If you want to get this strategy for your platform, click on that link, and there's some instructions on how to import it. There's a couple things there, so check that out. But I just want to show you a quick glance here that there was, over the course of the 360 days, there was 104 trades on this side. So in 104 trades, we made about $5,800. This does not include commissions. This is a back test. We're not trading options. We're just trading shares, 100 shares at a time. So we would buy 100 shares and go long and sell short 100 shares. This is not an options trade. We're not trading contracts with just straight shares, right? This is the foundation of the stock market trading system that this video series is about. So 104 trades, right? So 104 trades, $5,800. Okay. So on this strategy over here, where you're just trading the hourly part by itself, you ended up with less profit, total of let's say $1,300, and you traded twice as much, 223 trades, twice as many trades, right? And what is that? A fourth of the profit. So this is what I'm talking about. You do not need to be in the market all the time. If you miss a big move because the conditions are telling you not to trade, then just be okay with missing the move. You do not want to trade 200 and something times and actually make less money. What you want to do is trade less and make more money. And we're going to do that by establishing the stock market conditions by looking at, in this case, the daily chart. If the daily chart on the MOBO indicator is telling you to go long, then you're going to look to the hourly chart and you're going to take long signals. And when you get a cross back above against you, that's your signal. You get out. That's your stop. That's your exit. Now I'm going to go into more detail on the strategy later, but I just wanted to kind of convey to you that you're able to trade less and make more if you're using multiple time frames with this indicator. And again, we're focused on SPY options. They're the most liquid, and that's what this video series is about. So again, I'm putting a lot of things in the description of this video. On YouTube, you can download the market timing strategy guide, which is kind of a walkthrough of the strategy we just looked at. It's about a 10-page PDF, so you can download that. If you're interested in watching this more in real time, you can become a spider trader with me over on my website. You can see the link there, patreon.com/vertical spread options trading. And if you haven't done so already, be sure to like, share, and subscribe to this channel. And if you click that little bell, you're going to get notified when the next video comes out in this series. I'm going into really, a video on each aspect. It's going to be a full trading course. It's completely free. So hopefully you'll stick around and subscribe, and we'll see you at the next video. Thank you.